How do you value this market today?
I think that just the way you said it is going to be a fool's journey to say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay, you know what that means? You're going to outguess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and everything readjusts. What has to happen, I think, is investors, most importantly, have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio, because the way portfolios work, it's almost like for some part, something happens, another thing happens. In other words, what you can see in the markets today is that, let's say when equities go down because growth expectations falter and there's a greater likelihood of easing, then you see the bond market go up. Or when you see other markets, gold, watch the market action on every day, and you can see those relationships. But wealth is not destroyed as much as it is transferred. And if you know how to balance those investments, we do it in what we call an all-weather portfolio, but if you know how to balance those investments, that's the most important thing. Be in a safe, well-balanced portfolio. You can reduce your risk without reducing your return, and you will not market time this, because even if you were a great market timer, the things that are happening can change the world, so it changes what should be priced into the markets. Let's go back to sort of basics. For every individual, for every company, for every government, over a period of time, you have to earn more than you spend, and you have a balance sheet. There's an income statement and a balance sheet. When one becomes a reserve currency, others want to save in that, and that gives one the exorbitant privilege of being able to borrow in that and to create debt and money, because that's the thing. And it also gives us powers, like a lot of our sanctions come from the dollars being a reserve currency and so on. However, through history, it has always happened that currencies are devalued or destroyed. And in that cycle, when it becomes unattractive to own bonds or debt instruments in that currency, there's a supply-demand problem, because a bond is a promise to receive currency. So what you are is, when you own a bond, you're long a lot of currency because that's what they promise to give you, and they have the printing press. And then there are shifts that happen. Who is accounting for world trade?